What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Ehsan Khoman, Economist at the BlackRock Investment Institute. This week, we unpack the potentially historic shock to energy supply. The key issue is whether the sharp drop in shipping through the Strait of Hormuz lasts long enough to induce stagflation. We see a feedback loop between markets and geopolitics. The conflict boosts oil and gas prices, but the political and economic strain from higher prices may limit how long the conflict lasts. Shipping traffic through the Strait of Hormuz has plummeted due to attacks on energy transport and facilities in the Persian Gulf. Oil and gas prices have surged, leading the International Energy Agency to release around 400 million reserve barrels, a record, but likely not enough to offset the shock. This goes beyond spiking prices. It's a supply shock to energy flows with spillover risks to the broader economy. Physical constraints hurt growth, boost inflation, and sharpen policy trade-offs. The longer supply is disrupted, the greater the impact. That said, the impact varies by region. Equity markets in Europe and Asia have fared worse than the US since the conflict began. They import much of their energy from the Gulf, while the US has strong domestic supply, helping insulate it from the shock. We see a feedback loop at work. The conflict is driving prices, but prices could shape the conflict and potentially lead to de-escalation. Limiting shipping gives Iran leverage, but it also hurts them economically. Higher US gas prices, meanwhile, may heighten political sensitivity ahead of key midterm elections. We see limited places to hide from the near-term supply shock. Traditional diversifiers like government bonds and gold are not providing ballast as equities fall, an example of a diversification mirage we have previously described. We think risk assets could recover over a 6 to 12 month horizon if a clear end to the conflict emerges. In the meantime, we favor US assets. We also like hard currency emerging market debt. Emerging market debt indices lean towards commodity exporters like Brazil, which benefit as oil supply from the Gulf plummets. Here's our market take. A protracted conflict could tighten financial conditions and raise stagflation risks. Yet the same pressures driving the energy shock could also catalyze de-escalation. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.